So that field for KYE form, ignore it, totally ignore it. The whole platform is a KYE. Just ignore that form. So tell me, what was the best? I not asked this question last week, but what's the best part of profit program? What was the best part? Tell me, what's the best part? Brand storytelling. Interesting. Who else? Who else? What was your best part of the topic program? What part did you enjoy the most? Refining your idea has been the best part. Operational plan. Best part is seeing everything come together, identifying the problems to solve, pricing, branding, business canvas, interesting, value proposition. And some people really follow the program. Emmanuel, drive safe, please. Don't have an accident. TOEV, wonderful. Daily task, pricing, financial plan of 10 years, branding. Interesting. So one of the things I'm going to do today is to talk about the financial template and how to go about it. And we have somebody to take us briefly through it. And coincidentally, the person is actually an entrepreneur like you. So we don't just teach or we don't just, give you knowledge. We also empower you to help other people. So his name is Shegun, and he'll be coming online in a few minutes. Yeah, Femi, yes, Shegun, you got it right. Um, I'm seeing questions. I cannot save my documents in DMS. What do you mean by you cannot save your questions? Is it that when you upload them, it doesn't upload? What exactly is the problem? Shoma, you can't hear me. Other people can hear me, so you need to check your internet connection. Trying to get Shegun online. Yeah, Shegun is coming online. Hi, Shegun.
Hello, everybody.
Can you hear
Hello,
me?
loud and clear.
Yeah. Oh, great. So Shegu is going to take us through the financial model template. Very straight to the point, Shegu has become a guru, as they've told me now. So Shegu, are you going to take over from here?
Yes, I would try and take over almost immediately. Hello, everybody. How is it going? It's been 12 long weeks of us working on this, but we're at the end of it. Um, Over the last 3 weeks, we set up 2 weeks rather, we set up a group where we've attended to some of your questions, and we've done 2 sessions, but we realized that a lot of people could not join. So some people graciously asked OM to allow us to use their platform, and I'll just be going through some of the things we discussed. Um, if you are joining the session and you have your laptop with you, I would like if you could have a small screen of your Excel sheet so that we could go through it. As I am taking you through the processes, you can also be making changes to your work. I'll try and make it short because I believe a lot of us have completed the work, but then, we're meant to help each other. So let's start from the very beginning. I'll be trying to share my screen now, and if you can see my screen, just let me know by saying yes. I think it's coming up. Just give it a few seconds. Can you see my screen, please? Okay,
Wait while
just a
presenter
second.
looks his on screen. Hi everybody, just to introduce Shegun once more. Shegun is going to take us through the financial model template and how to fill it. So I'm very sure you're in good hands.
Okay, you should be able to see my screen now. Just let me know by saying yes. If you can see my screen, just say yes. Okay, fantastic. Fantastic. Okay, fantastic. Okay. So I will start from the very first page, which is the instructions. And I think it's good if for those who have not even touched that, or I know 90% of us have touched it, but let's just start from the beginning. Because a lot of us are submitting this same template, the foundation would like to know who is submitting what. So the very first page is you're just meant to pick from the instructions. All you have to do is write your entrepreneur name, write your company name, and your TEF ID. The company name, people ask me, what company name? Should I use the name of the product I'm pushing now? Should I use the name of the first, the company I used when I came on the TONY ELUMELU Foundation, when I registered for it? I would say you should use the final company name you have that you've submitted documentations for, because I believe that's what the audit Essential will be checking. Somebody say, yeah, that's what Essential will be checking for. I'm getting comments that some people cannot see my screen. If you can see my screen, just say a yes so that I know the number of people who can see my screen and the number of those who cannot. Okay, I'm getting a lot of yes. Fantastic. So if you cannot see my screen, I'm sure it's probably coming from your end. I want to believe that this is being recorded, so you'll be able to watch the video much later. For those who are talking about that, saying that I'm breaking, I would slot slow so that you can follow me. Okay, so back to the shared screen. Now, the very first page you need to fill in are your details, contact details. As soon as you do that, you can click on the Go to Assumption tab, and it takes you right in. Now, it's easy for us if a foundation has been able to do most of the work. So what they are saying is this: you don't have to build the entire, you don't have to do the mathematics of your income statement or do your balance sheet or your cash flow. Everything is automated. All you need to do is supply the basic information. And basic information, they are saying that at the end of these 12 weeks, you should be able to know what your business is about. You should be able to know the cost of the services you are setting up. You should be able to know, separate what your launching, your initial cost for setting up is, and separating it from your running cost. You should be able to know how much you would price your goods. You should be able to estimate how many people will buy from you. And they've said to put in those details, there are two sets of cells. So the cells that are light gray at the very top here are those where you can make inputs. That are dark grayish, almost brownish, areas where you cannot make inputs. And I believe that is very clear. Okay. Now, the very first information they would need from you is your business country. And the reason is this: your business country helps them know how much, first of all, helps them know your location. It helps them know the currency in which your business plan will be developed in. For me, for instance, I'm based in Nigeria. So all I have to do is look for where my country is, click on it. And if I click on Nigeria, my currency automatically becomes Naira. If for any reason I click on, for instance, Senegal, if you look at it, it's changed my currency to the West African, and everything I do on my sheet will be in that currency. So let me just quickly take it back to Naira, because I know I am working from Nigeria. Now, for some people have chatted me privately saying that they filled in their country, but their currency, business currency, did not change. Really, it should change. But if, for instance, it doesn't change, and if, for instance, you see your currency is different from what you are used to, you can change your currency to, for instance, in my own case, I can change Naira, or I work with dollars. Considering that the grant was in dollars, I know some of you can do the maths manually. So you can either say, okay, this currency that is, which is very rare. I don't think it will be a case, it will be your case. But for any reason, if your currency is wrong, you can work with dollars, and then at the back of your mind, all you know is that you're doing a manual calculations in your estimate. My currency is correct in Naira, so I leave it there. Now, the next section is the business products and services. Now, for many of us, we are selling a single product, but a couple of people complained and said, well, we have several products, and so the foundation sent in a new business template. Now, in the business template, you would see that they tell you what is your product service 1, what is your product service 2, and what is your product service 3. I am sorry, I know I'm looking to the side. It's because I'm using 2 screens. So I am looking at the screen I'm working on, although you're looking at me from this screen. So forgive that. Anyway, forgive me for that. So now you fill in your product, the name of your product. Now, if your company name is Awero and Sons, and you have Awero Maggi, or Awero Spicing, and you have Awero Pepper, and you have Awero Sugar, all you have to do is put in your different product names: Awero A, Awero B, and Awero C. Now, for some of you, and it's very important I answer this question now, because I got a lot of feedbacks here. Some of you say, I have 3, and this is for those who are, most of the people that are into services. Some of you say, I have 3 products, but these products are divided into subsections. So, for instance, I have a e-trading platform, and I have people who deal in bags, in shoes, in whatever. So I mean, there are different types of bags. What I would say, to make it easy for you, and this is a very genuine advice, I would say you divide your products according to price levels. And I'll explain to you much later why I say this. Now, if for instance you have 10,000 products, and some of your products are in the price of 1 and 100 Naira, for instance, and you have another set between 100 and 400 Naira, you have another set 1,000. I would suggest that if you have so many products, you categorize your products according to price levels. If you have only 2 products, it's fine. All you have to do is do product 1 and product 2. No problem. If you have only a single product, all you have to do is give your product name. In my own case, it is Increase Register, Loan Contracts and Private Register. That is one product. I have another product, Increase Connector Services, and I have a third, which is my profiler. So all you have to do is register based on this, and you can move on. Now, for the next empty spaces you need to fill in are company tax, bank interest, and inflation rates. Now, for these 3 items, it's easy, because all you have to do is, we expect some of you have started business and you have to pay tax. It's easy. What's your rates for your different countries? You know, just check it. You could Google it. You could go to your local tax office and confirm the figures. 3 information you need: what is your company bank rates, company tax rates in your country, what is your current bank interest rates in your country, and what is the inflation rate. Now, for instance, in Nigeria, I know it is 30%, so I put 30% there. In South Africa, I believe it is 30%. In South Africa, sorry, I think it's about 28%. In Kenya, it's about 30%. In Swaziland, for instance, about 27.5%. Check online, go on Google, you'll find the answer, and it's easy for you to fill that up. Bank inflation rates, go online. Bank interest rates, go online, do the same thing. Inflation rates, for us in our country, I mean, inflation rate last year was about 17%, but since January it has been dropping from 17 to 16 to 15, and we see a steady trend. Right now it's about 11.75 or 74%. Because of safety brackets, most of us, or a couple of us who work together on this sheet, we agreed that we would use 12% there. It might go up. That is fine. Next year, nobody can say what exactly will happen next year, but it's a business plan. You're allowed to modify your business plan in the next 2 to 3 years. But for now, based on current realities, I believe that Accenture will be checking to see that you did your homework and you put what is marginally acceptable in your country. Now, okay, sorry, I'm just reading the question. Is it possible to get a version 2 final copy of the financial model? It's online. Check it online. Albert, I see your comment. You're saying that in Uganda, inflation rate is 24%, company tax rate is a certain amount. I mean, that is fantastic. If you have the information, put it there and we can move on. Now, for depreciation rates, if you notice it, these tables were not left blank for those figures. This is because most people have fixed depreciation rates for when you look at accounting principles. Now, some of us are different. Some of us, we are saying, well, I use my vehicles a bit more, and in 3 years, I want to be able to change my vehicle. Therefore, my vehicle depreciation rate will not be 5% because that means that it depreciates over 4 years. No, it is 3 years. All you have to do, it's a very, very simple mathematical calculation. All you have to do is saying the number of 100% divided by the number of years I want my equipment to depreciate in, and that will give you your depreciation rate. For instance, I want it to depreciate in 5 years. All I have to do is 100 divided by 5, and that is 20. In my vehicle depreciation rate, I will put 20 there. If it is the case with your equipment, you want to depreciate in 3 years, all you have to do is say 100 divided by 3, that's about 33.34%. Put it there and you'll be fine. And that is how we calculate our depreciation rates. Now, if you do not want to change what is there, it is fine. If you want to change what you are permitted to. And that's why those sections are in light gray. You're allowed to change it. Okay. If you're with me, can I just get a quick yes? If you can hear what I say, and if you understand how I explain the depreciation rate, can I just see your comments? A quick yes. Fantastic. Yes, yes, yes. Okay, fantastic. So everybody's following so far. I see a no. For those who are saying no, I will repeat I'll summarize. For your company tax rate, your bank interest rate, and your inflation rate, go online, look for the values. You could find it there and fill it in. If you have an accountant, a friend as an accountant, you could ask them what you should use for those numbers, fill it in. For depreciation rates, Accenture already filled in figures there. If you believe that it doesn't apply to you, you want to alter the way your depreciation works, all you have to do is a simple mathematical calculation. 100% divided by the number of years you want your product to depreciate in, and you get whatever you get, fill it there. So if it's 100 divided by, you want to depreciate over 5 years, 100 divided by 5, that's about 20. You put the figures here, and you could do that for all your products.
Shegun, you have to go at a faster pace.
Okay, I need to go at a faster pace. Okay, fine. So I'll move quickly. I'll move forward. Section B. Section B is really the hardest, is one of the most difficult sections to fill in, because most of you are asking, what is all this percentage calculation? And for that, I built an Excel sheet which I'll show everybody very quickly, and I'm sharing it now. If you don't understand what they mean by growth rate, it's very simple. And picking, for instance, your revenue. You have year 1, year 2, year 4, year 5. Now you can easily say how much you want to sell your products, right? I mean, it is your products. If, for instance, in year 1, I want to sell it 50 naira, I put a naira there. Year 2, I want to sell it 100 naira because I'm going to double it. I've already gotten a lot of customers. You put 100 there. Year 3, I want to put 120 because I'm not going to increase my price. You put it there, and on and on. The same thing for the number of goods. If, for instance, you have 2 products, you're selling 2 products, you're selling 2 units of your products. Year 2, you're saying I'm selling 3 units of my product. Fine. Year 4, I already have market share and I'm selling a lot more. You could put the numbers. It is not rocket science. Just put in the numbers. Now, you have your numbers here, because you do not understand the mathematical formula. Fantastic. I'll leave that. I'll say this. And let me just drop a notepad quickly. Now, in calculating your growth rate, all you have to do is say your the next year 2, or following year's figure, year 2 figure minus year 1 figure. Take note of the brackets, divided by year 1 figure, and that gives you your growth rate. I would like for all of us to take note of this formula, because it will help you with your calculations. Now, and this applies to every single thing you'll be doing in your growth table. So it could be, you could be talking about your pricing. So year 2 pricing, 1 pricing, whatever you get, divided by your year 1 pricing. To some of you, it could be number of goods sold. Year 2 goods sold minus year 1 goods sold divided by year 1 goods sold. That gives you your growth rate. And I actually built the formula here already. And if I apply the formula, it already automatically calculates my growth rate for me. So in moving from selling 2 products to 3 products and 4 products in year 3, it already calculates that my growth rate is 50% in year 2, 33% in year 3, and 25% in year 4. And you can calculate this on and on. It's very, very easy. It's very, very easy. Use the same formula, you get it. Now, from what you see, they are positive growth rates. But some of you might say, in year 1, I'm spending 100 naira. Let me clear this quickly. In year 1, I'm going to my cost. In year 1, I'm spending 100 naira on rents, for instance. In year 2, my landlord is going to decrease rent, and it's 80 naira. It's still the same thing. All I have to do is, my growth rate is year 2 figure, which is 80 naira minus 100 naira divided by 100 naira. If you look at my table that I have on my screen, it has calculated it, and it tells me a minus 20% growth rate. So yes, your growth rates could be positive, your growth rate could be negative. If you are comfortable with estimating based on figures, fantastic. You do not need this table. Go straight there, dig in there, fill in the figures. So, and I've gone back to our Excel sheet. So for revenue, for instance, my sales volume, please take note. Unless you started production previously before this project, I suggest you leave year 1 table, start from your year 2, and I explain that later. So I'll explain that later anyway. So year 2, my growth rate, I'm expecting to sell 500% more than in my year 1. It's very simple, 500%. Year 3, 800%. Year 4, 350%. I have done my calculations in the background, and I'm coming to fill the figures on the sheet. The same thing, my pricing, I expect to increase my pricing in year 2. In year 3, I don't expect to increase my prices, the prices of my goods, till my year 5. I put that figure in there already, and that's how it is. You do that for your products, your different products. I mean, I'm assuming they are priced differently. Products for your costing as well, do the same thing. What is different in my year 2 cost from my year 1 cost? If you apply the same formula, you would get your growth rate. If you understand what I just said, can you just say a quick yes? If you understand the calculations, so growth rate, next year calculations minus your previous year calculations divided by your previous year calculations. Fantastic. I see a lot of years on growth rates. With this, I assure you, you've gotten 90% of your work completed. Somebody says a big no in capital letter, Ejiro. I would say this one last time. On the tables, the growth rates are in percentage. To get your percentage growth rates, all you have to do is say my next year figure minus my previous year figure. Whatever I get, I divide it by my previous year figure. So figure divided by year 1 figure. year 2 amount minus year 1 amount divided by year 1 amount, year 2 sales minus year 1 sales divided by year 1 sales. That is your growth rate in year 2, on and on and on. Will all, I say a question here, will all every year be divided by year 1? No. Listen to this again. If, for instance, I'm calculating my growth rate in year 5 is year 5 figures minus year 4 figures divided by year 4 figures. So it is future rates, future sales, future amount, future number minus previous year or current year amount. So next year minus previous year divided by previous year. And that is how you calculate your growth rate. If you fill this in for the next 10 years, you are 90% done. Do it for your revenue, do it for your cost, and we can move forward. Someone asks, I should repeat what I said about people who haven't started production. If you've not started selling at all, leave year 1 figures blank. Leave year 1 on your growth rate table, leave it blank. Start with figures. Start with year 2 figures. I mean, you probably know your year 2 numbers. You might not know your growth rates. So you calculate your growth rates. I mean, but leave that growth rate percentage for year 1 blank. Oh, fantastic. I like what Sarah just said. I see your formula there and it is correct. Now, because of time, I'll move directly to your section C. Section C is talking about your startup costs. And these are in accounting, we call them ARCs costs. These are the initial expenses you expect at the beginning of your business. And some of you, for instance, you're going to buy land. The land is yours, is a capital expense. It is a fixed expense that you do once and for all, and the land belongs to you. It is totally different from rent. Take note of that. For those of you who will be getting office space, for those of you who will be renting factories, it's totally different from your rent. This is your startup cost. Now, what is your startup cost for land? On that, and if you scroll up, you'll see what they write there. They write a baseline. A baseline on the very top. And if you see me, I'm putting my icon, a baseline. Now, that's where you fill in the figures. Your baseline for your land, how much are you going to buy your land? How much are you going to build? If you're going to build, how much is the cost of building? How much is the cost of your furniture and fitting, which belong to you? Now, if you're renting an office where they furniture and fitting, you don't have to fill this in. If you're going to bring in your furniture and fitting, even though you're renting space, put in the numbers there because it belongs to you. The same thing, equipment and manufacturing, vehicles. If you're going to have to buy vehicles in your year 1, put in the number there. Now, some people ask me, oh, I don't expect to buy vehicles in my year 1. It is fine for now. I suggest you put in the figures here because no way to manually adjust it. Some people, let me rephrase that. Now, there's no way to manually adjust it that is easy to explain to you unless you're a finance guru. So if you're not a finance guru, I suggest you put it there. When you go to your business plan, the Word document, you can state it as part of the assumption that you do not expect to buy the vehicle in year 1, but you are making accommodation for the costs. Yes, some ask, is the baseline mandatory for the new business? I assume yes, because there are some expenses you have to make in your year 1. So you have to fill in your baseline. And also there are some estimations that we would make further down in our Excel sheets. So you have to note that baseline is required, but do not fill baseline for your entire business. Fill baseline for the capital cost that you'll be making in your business. And I'll go down because of time. I'll move on immediately. Now, there's a section that is marked in red beside your baseline cost. Those ones you cannot modify it. Do not worry, leave it blank. Accenture has made it easy. The calculations come up almost automatically. And look at it, for instance, in where I said vehicle 5 million naira my baseline cost, automatically it tells me that in year 1 I would be spending 5 million on vehicles. Now year 2 is blank, year 3 is blank, year 4 is blank. Why is that? Because according to my depreciation calculations, I put a 25%. 25% means that my vehicle depreciates after 4 years. So year one, I'm not buying. I have a vehicle. Year two, I'm not buying a vehicle. Year three, I'm not buying a vehicle. In year four, it has automatically said I need to take note of vehicle cost, and it calculates them for that for me almost immediately. So leave any area marked in red, you can leave it. The next session talks about opening inventory. Opening inventory is very simple. In the glossary, they've given a definition. It is the allocation for purchase of initial stocks of products or goods that will be produced in the first few months. And I'll explain that to you manually. Now, some of you buy goods from people and it takes time to ship in. So let's assume I buy goods, it takes 2 months for me to ship it in. I sell iPhones. It takes 2 months for me to ship the iPhones from China or the US. Now, if I started my business now and I bought only 1 month's worth of stock, or I start my business, it means that if I do not have 3 months worth of stocks, everybody that orders for my product, I will not be able to deliver till year 3, which is bad. So therefore, my opening inventory should be 3 months worth of stock. And that's what that is about. All you're about to do is do a drop down. How long will it take for me to replenish my stock so that my customers are not stranded? And that's what opening inventory is. If you are going into services, how long does it take for me to offer the service to a customer? If you are going into agriculture or you are selling food, how long will it take for me to grow new crops to replenish that which I would have in my warehouse when I start selling to my customers? So that's a very, very simple definition of your opening inventory. Initial working capital. Initial working capital is basically the amount of cash you need to go about your running costs for the first. And for example, if I start my business today, and even though I sell today, my payment term for customer is they pay after 30 days. It means that if I do not have money with me, my business will close down almost immediately. So I need to have 2 months worth of working capital before I open my business. If, for instance, it takes about 3 months before I make my first sales, I need to have enough money to sustain the business for the next 3 months. And so all you have to do is click on the drop down and say 3 months worth of working capital. Contingency is just a percentage of the entire business which you want to have as ready cash for your business. So if from all your business calculations, you know you've calculated I need 100 naira to start my business, and you're saying worst case scenario I need extra 20 naira, or that is actually manually calculating that 20 naira of 100 naira means that I need to have 20% contingency cash for my business, and all you have to do is manually click it and say 20%. In my own case, say 15% additional costs cash for my business, and so my contingency in my own case is 15%. For some of you, it could be 20. Some of you it could be 30. Click it there. Some of you might do this and you will not see figures almost immediately. Do not worry. Do not worry. Do not panic. As you fill in the areas where you are meant to fill in, the sheets and the documents automatically update itself. Somebody asked a question, please, where in section C can I input the cost of my rent? I'll tell you this, calm down, do not worry. If you've not seen inputs for some of the questions you have, I assure you that as long as it's not a capex cost, I assure you that Essential made room for you to fill this in. As we go down, you would see areas for this. So do not panic. Do not be in a hurry to fill this sheet. Take it one step at a time. So now, if you're following me, if you have Excel sheets open, hello?
Yeah, I might have to cut you off here. So
once again, the good thing is that I feel the pressure we're all feeling because I'm in this boat with you. Sorry, I decided not to use my camera because it's distracting. I mean, it's not my face that matters. It's understanding what we're meant to do and how we're meant to complete this. Now, I will take this in 2 ways. One would be to wrap up the discussions we started with on Friday. And then the next thing I will do is to answer questions. I will try and concerning your questions, based on the discussions we have or based on what I'm saying, I'll try and mark as many that I feel are relevant so that I can answer them after the session. So we can start now. When on Friday we started with the assumptions, and then we got to the place where I think we stopped at section D, where we were looking at the human resource requirements. Now, most of us have finished our work on our Excel sheets. Some of us are already submitting our documents. It's fine. If you feel you're done, you can always, you are free to do whatever you want to do. If you're not done or you've not submitted, as I go through, you can take note of what I'm saying, and if it tallies with you, you just know, okay, fantastic, you've done a good job. You can move on. If you've not done it at all, please have your Excel sheet open by your side. I'm sharing my screen. If you can see my screen, can you just say hello? If you are seeing my screen, can you just say yes? Okay, I can see hellos and I can see yes. Fantastic. Some of you are saying you cannot hear me. I do not think it's from my end because I had a chat with UM earlier and he could hear me perfectly and I could also hear him. So I guess it's from your end. The good thing about it is that I believe it's being recorded at the background, so it will be shared. So if it's not clear now, I'm sure it will be clear when you play the videos afterwards. Okay. So we can continue. So I have your screen. I'm sharing my screen. If you can see my screen, can you just say yes? I have the Excel sheet open. If you can see my screen, can you just say yes? Okay. Yes. Okay, fantastic. So I will go there. I see someone saying that I should go back to the assumptions again. I am on my assumptions. I am just in section C, assumptions. I will not start from the very top, but when we are done, so that people that have followed up to this level, they can just wrap up what they are doing and they can go on to other things. When we are done, if it's still a problem, I will go back to the earlier part of the assumptions, but I'll continue from where I am. So now we're looking at the startup costs in section. No, we're looking at the counts. Now, the very top of the head counts, and this is where the resource planning comes in. Now, the very top first question you see on the headcount analysis is the benefit percentage of salaries. They are indirectly asking you that beyond the baseline salary you pay to your staff, are there any other costs you would have? Cost could be things like health benefits, things like insurance, things like housing, or it could be, if for instance, you've included these factors in the baseline cost, it could be things like bonuses. Are you going to have to pay bonuses aside the salary at the end of the month? In Nigeria, we have what they call 13th month salary, and so some people that percentage from your agreed contract or from your baseline salary amount is what is called the benefit of the salary. And you could say 20%, but take note, for this you do not put 20% because if you look at it, there's a percentage sign in front. It's actually asking you that you should calculate it in terms of decimal points and not percentage. So if I put, for instance, 20% there, it calculates it at 20 times my cost, which is actually about 2,000%. So please use the decimal point. If I'm saying 20%, rather than put 20, I'm going to put 0.2. 0.2, and then it calculates it at 20%. So just take note of that. Once you do that, you can go straight down to the lower sections. Now it expects that you have different departments and different levels. So for example, there's always a management will take all the decisions that the company do. They define that the they're usually the highest day-to-day decision-making body. And so because of the responsibilities on their shoulders, I mean, their salary is always different. There's also different departments. Some of you will have business, some of you will have production, some of you will have sales and marketing, some of you would have engineering, some of you would have the farmers, all that are things that you would need to take note of in your planning. And I'll start with, so there are two aspects in each skills. Please note this before I continue. You are permitted to alter your department. For example, this senior management, if for example I don't have management, I can change it and say farmers. If you look at me, I just changed it to farmers. So you are permitted to change the description of your different structures in your company. You are allowed to do that. There are no issues if you do that. You do not have senior management. Some of you are just the boss. If you're just the boss, you could just make it CEO, and then you decide, I mean, how much you pay yourself. Now, the first thing he expects you to say at the very top is the number of employees, which means that they're asking that how many employees are on this scale. Now, in year 1, year 2, and he expects you to respond to fill that in for year 1, year 3, up to year 10. He expects you to do that. Now, if, for example, you are the one who is taking all the decision in year 1, fine, you could put 1, exactly what I put in the Excel sheet I'm showing. If in year 2, you want to bring in a CFO, you put it as year 2. Now, some of you would say, oh, but I have a finance manager. The truth about it is you could have a finance manager, but he's not a CFO. A CFO means that he's on board in taking management decisions. A finance manager means that he just, for example, takes care of your accounting, your bookkeeping, your payments. They are two different things. So if you have an accountant, but he's not in charge, he's not on management, he's not on that level. So you could put 1. If, for example, in year 5, assume you are the one taking all decisions, but you've gotten to a stage where the business is very, very massive, and you decide to have a senior finance person, you have decided to have a senior operations person, you decide to have a senior salesperson. All you have to do is change the number and say 4 or 5, and that's it. The next thing is, what is the base salary you'll be paying your managers? What is the base salary you'll be paying? What you do is that if you know the monthly amount, just multiply it by 12. If you already have the fixed amount, I mean, for example, in places like the UK, they do not calculate monthly salary. They just tell you, oh, how much you want to be paid. And when they say that, they mean annual pay. In Nigeria, people basically say how much you want to be paid per month. Whatever you want to pay per month, multiply it by 12, because what they expect there is the base annual salary. I go down to, and if you do that, that is the first case. Now, if you go down, you see business development. Remember what I said, you can actually change the departments as you want. Now, in each department, there are people who will be taking leadership roles, responsibility, and there are people who will be instructed on day-to-day. Now, the higher people, you call them managers. You don't expect to pay managers the same thing you pay the associates. You don't have to expect to pay your HR manager the same thing you pay the front desk personnel. So take note of that. You have to understand how much you'll be paying different people. Now, again, the same thing applies. How many people will be managers? If you don't expect a manager in the initial stage, you expect to be doing all the managerial work yourself, of course, that is 0. If you and you could do year 1 to year 10, if at a point you decide that you cannot take all dons, you cannot lead the day-to-day activity, you need managers to fill in some of these responsibilities. All you have to do is fill in the numbers based on how you expect your business to grow from year 1 to year 10. Now, the same thing, how many associates, so how many lower level staffs will you have? You feel it the same way, and the number depends on you. Now, and this is why I say you need to understand what you are doing, and only you would understand what you are doing. You need to understand the scale of your business. Now, if for instance you know that you need 20 people, do not say, well, other people are putting 1, 2. Put the 20 people there. If for instance your business will scale so much that by year 3 you will have people, it's fine. Put the 100 people there. It is your business. You know better than any other person. after you fill in your number requirements for the 10 years, you come and you say, how much will you be paying per annum? Your baseline salary per annum for year one. Calculate it per year. The good thing about it is this: you say, but in year 2, year 3, year 4, I want to be able to increase my staff salary. If you followed me during the last session, you've taken note of that in your growth rate. So in your growth rate, you already put in how much the rate at which you would increase salaries. So some of you would say, I'll be paying this amount for the next 3 years. In year 4, I expect to pay them more. Go back to your growth rate, B or C, and fill that in. It's very easy. So you fill in your amount. Immediately you put in the number. If you look at it, it automatically updates figures. Now, if I go to my growth rate, I can say, okay, I want to increase what my staff earn there. If you look at salaries, put in the percentage increase. If it comes down, it automatically updates. So all these areas in that have these red boundaries around it, these red borderlines, are areas you cannot edit. So it means that there are formulas that are there which are out of your control. Do not worry about that. It will fill it up immediately. Now, do that for business development. In my case, do that for sales, do that for the marketing, do that for the technology. Oh, do I need a manager there? Take note of the numbers of managers you need in your business. Take note of the number of employees, lower level staffs. Fill in the salary you expect for managers for a year. Again, it's for a year. Fill in the base salary for the graduates, the associates, the people that, okay, they are just involved in your day-to-day, they do not take decisions. Fill it there. Once you are done with that, once you do that, you are actually done with section D. You can go down to section E. Now in section E, this is where you look at your operating costs. Now remember where we talked about land, we talked about furniture and fitting, and for those expenses, they are capex expenses, which mean that they are expenses where you don't do them every year and you do them once and for all. And most of the time, they're usually assets which belong to the company. Now these assets, even though you spent the money, you do not lose the value of the assets. They are still your properties. I mean, if you buy a laptop now, in the second year, the laptop belongs to the company. The laptop does not have zero value because this is a complete financial model. Your accountant, or your auditors have to keep the value of the laptop in the following year so that your books look good. So, I mean, those are capex costs. In this case, these are operating costs. These are costs that maybe you make them, they've been made. They've been converted from cash to service. Now, the very first part says your direct cost. So for this direct cost, why they are separated, they are saying that if you produce, what are the costs that are associated with your direct production? I will rephrase that, and I mean in a different way. Now, to produce, let's assume that you produce cement. Now, to produce cement, how many trailers of lime, of sand, of whatever chemicals, trailers of it do you need to consume to make that 100 bags of cement? And those are your direct costs. Your raw materials, the direct labor included in those in producing the bags of cement, your factory overhead costs. For example, do you have to have 20 on standby to support your processes for that direct production? Inbound transportation. Now, somebody asked me a question and I'll really answer it almost immediately. What is the difference between inbound transportation and transportation in your fixed cost below? Inbound transportation refers to all expenses that related to your direct costs. For example, you are into importing iPhone. Sorry, I'm biased. I keep on using the iPhone. Now you are into importation of iPhones. You buy it from China because you do not want to buy it from the people that are in Nigeria because their costs are so high. By the time you put your margin on it, you do not make profit. You want to go directly to China or go directly to the US to buy it. Now, the cost of you buying those phones in the US are part of your direct cost, but they are part of your raw material costs because they're the purchase. Yeah, I mean raw materials. Anyway, now the cost of shipping it from the US to Nigeria and clearing it, and after you clear it and moving it to your factory, and from your factory moving it to your shop, that is your inbound transport cost. They're the cost directly, they're the cost that you need to make to ensure that the goods are moved from wherever they are produced to wherever your customers can see them, and that is your inbound transport cost. I hope that makes sense to everybody. Of course, that is separate of fixed cost. Now in your fixed cost, you have your salaries, you have the rent. So if you are going to get a shop, going to get 2 shops, going to get 3 shops in your year 1, fixing that cost. Those are, and remember, you're feeling it in the baseline area. You're not feeling it in the areas marked in red. You cannot access any information. You access any of the cells that have these borderlines, this red borderline. Fix it. What is your baseline cost for year 1? Now, do not fix for the entire test. All you have to do is fix for year 1, and it automatically updates it for you. Take note, do not put in special signs. Some of you sent sheets to me saying that, oh, it's giving me this value error. Can you see this? I hope you guys can see this value error. Now, whenever you see this value error, it means that somewhere in the past you have used a special character which the system does not recognize. Go back to those to your inputs. If you clear the special signs, it immediately process the information. The Excel sheet is able to accept the information you give it and work on it. And you do that all for your fixed costs. Now, somebody asked me a question. Oh, I cannot put an input, or I put an input in my salaries and it's not reflected in the change. The reason is this. You are not expected to make any inputs in the salary area. Why? Because you've already done that here in your C. So your section D is for salaries. Once you do that, it automatically does the calculation for you and fills in year 1 to year 10 projections for your salary. Please do not put any figures in this area in your operating cost for salaries because you've already done the work in section D. Straight on directly to section F. Section F is for your revenue. Section F is for your revenue. I hope you guys are following me. Do not worry if you are not following me. As soon as you're done, you can always download and listen to the podcast. If you have questions, if you're following me but you have questions, please jot it down. I would allow you to ask questions as soon as we finish. So revenue, if you look at it, it has my product. So it doesn't show product 1, service 1. It doesn't show product / 1. It shows the actual product the actual name of my product. Why is that so? If you scroll up, remember in section A, where we filled in our product name. So where we said business product and services in product A, product service 1, I filled in the name of the product. It notes the description I want to give to my product 1. It notes the description I want to give to my product. It notes the description I want to give to my product 3, and it automatically updates the label in my revenue section. So in my revenue section, I have my product name. My name of my product is Incrib Register. It's a loan contract and private register for my customers, and it automatically updates that there. What you're meant to go to is your base monthly sales volume. So you ask yourself, how much would you ideally want to sell in a month? And take note of my definition for this. Base monthly volume refers to the number of units of products you want to sell every month. It doesn't mean you would sell that number every month, but it means that this is what you are targeting to sell. This is your aspiration. This is your intent. I want to be able to sell 10 bags of cement every year. I want to be able to sell 10 trailer loads of cocoyam every month. If you're into providing services, I want to be able to attend to 20 clients every month. Not every year, forgive me, every month. That is your base monthly sales volume. Now, your base monthly sales price is how much your service or your product costs to that transaction you made. Now, if you remember, I initially told you that for I'm in the early part. I told you that for year one projections, leave your baseline empty in section B. And I'm scrolling up there now. So in year one, in the growth rate, we left it blank. And this is I remember I said I will explain to you why we're leaving it blank. Now we left it blank because further down in section F that we are, you are going to put in that amount. It's automatically calculated for you. So let me move forward very quickly. You finish your base monthly sales volume, you finish your base monthly sales price, and you move down. The next section is the seasonality estimate. Now, this was put in there. Some of you will say, what does it mean to you? Seasons do not affect my business. Oh, that is fine. Hold on, just hold on. Do not jump the gun and ignore this section. Some of you are in agri business. You do this, okay, yes, seasons affect my business. Sometimes I can produce and sell, sometimes I cannot. Fantastic. Over the next 10 months, January, February, March, April, May, try and take note of the effect of seasons on your sales and put it there. Now, for some of you that say, well, it doesn't affect me, think of it this way. You sell laptops. Now, at the beginning of the year, how many companies actually buy a lot of laptops to their staffs? They do not rush. They usually, management does a budget for the year, they do recruitment, and then they have a better view of how many laptops they want to buy, and then they usually order in February. And this is me talking because of my experience as a salesperson in my past life. Now, you need to say, based on my customers do not buy the same number every month. In January, February, it's difficult. Sales, March, they buy. April, end of the year, beginning of some calendar years for them, they do not buy so much. May, they start procuring up to December. December is the end of the year, they do not buy so much. It affects you. So please, these are seasons that affect your business. You're into entertainment, enjoy themselves more towards the end of the year, and they enjoy themselves towards the holiday season, summer. So August, September, when the children are on holiday, they spend more, they go for more parties, they do more events. You know, those are seasons that affect your business. In January is not so much. The essential in their wisdom, and based on their practical experience, know that every month. So they've given you room to make this addition, to accommodate this. So that's what you do. Please try and feel this, and then you are allowed to explain the reason for seasonality. Please, you are allowed to explain it. Is it compulsory? No, it's not compulsory. But if you do it there, it will help whoever looks at your business plan how you think. It will show them that you are very smart. To show them that you understand your business and you're taking into consideration the different fluctuations in sales. And as soon as you see that, do that, there is this graph that updates itself. I mean, it updates itself and it adjusts, shows you the impact of your analysis. Also, further down, it automatically, now somebody asked a question in one of the group and it was like, oh, why am I putting in my monthly forecast, or where did the system get annual sales when I just put in monthly forecast? This area, it has been done for you. It has automatically been calculated, so do not worry. Now, for some of you who are using the original Excel sheet that only has one product, once you do it in that in that Excel sheet, because you don't have product 2 and product 3, you do not have to see all this. Now for those who are using newer updated Excel sheet that has the different product lines, you do the same thing for your first product, the same thing for your second product, do the same thing for your third product. If, for instance, that you expect the rate of sales to be the same, what just varies is the different prices. Say, bon, do not worry, there are no issues. All you have to do is copy whatever you did in your product 1 into product 2 and product 3, and it calculates it for you. Please, I know that some of you will have questions. We'll get to that, but take note of what you have to do. If you understand what you're doing, that you have less work going forward. So put in your base price volume, put in your base price, consider the effect of seasons, consider the different months in which the fluctuation in your sales, fix that in, and you are done with this section. Every other thing, the system automatically calculates it for you. Working capital. Now I'll explain this to you. Now, working capital is really the amount of cash you need to run your business day to day. It's important because this section is very important, because then it will help. In fact, it's what helps calculate your cash flow sheet. This is where you get most of the formulas from. This very small section has a lot of weight. So they're trying to say that now some of you have business where your customers do not pay on time. You need to take note of it. You need to take note of the delay, because if it takes 30 days for them to pay, and they buy products in the middle of the month, now and you use all your money to buy the raw materials to produce and sell to them, it means that by the end of the month you will not have money to pay your staff, because you have 10 naira to produce, costs 10 naira. You employ somebody who you pay 3 naira to. Now if they buy the goods, you produce the goods with 10 naira, they buy it 15 naira, but they do not pay till 30 days. It means that the only time you will have money is in the middle of this. It will be very bad for your business to employ your staff and they see you selling and they are saying, where's your salary? So you have to actually have extra 5 naira somewhere so that you can pay your staff 3 naira. And then if you have to pay your NEPA bills, you have to pay your transport costs, you have 2 naira for that, so that you are not stranded. This is the section you fill it in. Now the very first space there is receivable date. Receivable date is simply saying how many days from when you pay do you expect payment. If you look at the description below, they said average number of days customers take goods to take days customers take to pay your business for services render. It could also be the average number of days customers take to pay your business for the goods collect. Put it there. They pay after 30 days, put it there. If you are saying you are into an online payment system where people have to pay before they even get the service, people have to pay. All you have to put the 0 there. Payable dates. Now, payable dates in this case is saying how many days do you take before you pay for the goods you bought, or pay for the materials you used in production. Now, for example, for people now, they buy materials from the market. If you're into fashion and you've been doing this for a long time, your customers, your suppliers know you. You could go to them and say, this material looks good though. I don't know if my customers will buy, but give me 10 yards. After I finish making it and I sell to them, I will come and pay you. The guy says, okay, you know what? So that we do not, I don't want to tie my money at the message of when you sell. But you know what? I will give you this material for 30 days. After 30 days, okay, I'm coming close to my mic. I'm seeing your comments. Someone said I should speak louder, so I'll come closer to my mic. And I'll try and speak very slowly so that you can pick up what I'm saying. Now, payable dates. So I was saying that after 30 days, the guy allows you to take the goods. All you have to do is say 30 days. 30 days is the date from which you collect, the number of days your suppliers allow you to keep their goods before you pay. Now, inventory day. This is very, very important. Now, and I will explain it carefully. Now, inventory days really, it refers to the average number of days required for your business to sell one batch of inventory. So, for example, you finish producing your goods, but it is in your store. It is not generating revenue for you in your store. It is not generating you buy iPhones, you put it in your shop. You made money, but you've spent money. Now, how many days does it take for you to sell that phone? You make shoes. You've already made 1,000 units of shoes. How many days is it on your stand before you sell it? Now, some of you say, well, I make to order, so you must have ordered it before I even make it. Therefore, I do not keep goods in the warehouse. It means that your inventory date is 0. And then you have to sell. The number of days on average you have to store it is your inventory days. It could be 15 days, it stays in your shop. Fine, please input the number because it helps you calculate your cash flow. And once you've done that, you finish with your working capital, section G. You can now go directly to section H. Section H refers to your startup financing. Now, if you've looked at your entire sheet, by now you would know how much it costs for you to set. Now, how much of it do you already have? How much of it is coming from your pocket? How much of it is coming from your pocket? That percentage is what you put there. Take note, you do not put 10%. All you have to do is just 10, and it indirectly takes it as percentage. You don't have to put the percentage sign after you put that figure there. If 20% of the amount is coming from your pocket, put 20 there. If it's 30%, put 30 there. How many percent is coming from grants? You already know that TONY ELUMELU Foundation $5,000 or the equivalent of $5,000 in your local currency. What does it equate to in your total startup cost? Are you going to get funding from other people? Add it together. What percentage of it is coming from grants? Put it there. If it's 20%, put it there. How many percent is coming from equity? How many percent are you allowing external investors? How much are you allowing external investors to give you? What percentage of your total startup cost is that? Put it there. It's not a problem. Debt. If you're going to collect loan from your banks, how many percent are you collecting from banks? Put it there. Now, before I say something, some of you would see that there's a red. It's tagged in red. Initially it was green, now it is red. It's why he's saying this is because it expects your total percentage here to be up to 100. If it's more than 100, it means that you've not done your calculations right. If it's less than 100, you've not got your calculations right. Now, if for instance, I'm not taking money from bank and I'm not going to get a loan and it's showing me 90%, it means that somewhere along the line, I have not done my calculations right and I need to calculate it. Oh, for instance, I noticed that I'm actually giving 40% of the initial startup capital and not 10%. Immediately I update this to 40%. The red filling disappears. It shows me 100. It gives me this green color. It means that I am done with that. C'est fini. Your startup financing, you filled in that section. You can move directly to section I. Section I is equity funding. Now, if you notice it, for year one, you are not allowed to fill it in. You'll be like, oh, but I'm putting in money in year one. Do not stress. Whatever money you needed to put in year one, it has calculated from you. It has calculated it for you from all the information you've put in the past. And that's how easy this template is. There are some things that it would already calculate for you. And one of the things it helps you calculate is your equity injection. Year one is done. Now, if in year two you want to raise money because you're not breaking even, but you've been able to prove that your market is viable, you go out, you tell people, this is what I'm doing. If I put in 1 naira, I get 2 naira. And the person says, oh, but you're making a loss. You say, don't worry. It's because I initially put in 1 naira. In year two, year three, I expect to put in 50 kobo. It means that okay, I can see Okay, fantastic. Sorry, I saw somebody saying I should speak louder. I'm going to try and speak louder. So if, for instance, it means that in year 2, although you are not making profit, you can prove to them that you're a profitable business. But then you do not have money again. You need people to finance your day-to-day running so that you do not, your staff do not leave. How much do you want to raise? That amount you need to raise is what you put in your equity injection, and you put it from year 2. If in year 4 you want to go to market, you put it in year 4. You put the amount you expect to raise. You want to raise £1 billion. Fantastic. Some of you, your dreams are massive. Just put it there in year 4. If, for example, you're not trying to raise money from anybody, from year 1 you're profit, no problem, leave it empty and you can move on. You finished equity financing in section I, you can move to section J. Now section J, I know that in all the podcasts I did, in all the sessions I held with people, I always skipped section J. But in this case, since we're doing it on this, I'm going to explain it carefully. Debt financing refers to people, it's this, if you are not collecting money from external sources as loans, if you're collecting as equity, you fill it in section I above. If you're actually, however, collecting it as a loan, which you have to pay back at a certain interest rate, you need to fill in section J. And all you have to fill in debt facility 1, all you have to fill in is what year will you borrow the money and how long will it take to pay. That is all. Do not make changes to the amount borrowed. Do not make changes to the loan end. If you do that, you'll be altering the formula that have been put into the Excel sheets, and it will affect all the results you get. And that is why it's colored differently. You notice it's a darker shade of gray. It means you should not make any changes there. Please take note. Now, if you are collecting more than one loan facility, one debt facility 1, fine, you're collecting another one. In this case, you're allowed to fill in 3 sections. What section? You're going to fill in the year you expect to collect. If you are collecting this loan in year 1 again, but it's going to be a different loan, you're allowed to fill it there. You need to now, year 1 will now apply. So from year 2, year 3 to year 10, if you're going to borrow money, fill it there. It's a drop down, is easy. Put it there. In year 6, I'm expecting to collect money. I put it there. If you're also allowed to put in this case, the amount you expect to borrow. If you're expecting to borrow $20,000, put it there. If you're expecting to borrow 5,000 South African Rand, put it there. If you're expecting to borrow 2,000 Naira, put it there. Then how long will it take for you to this money? How long are you going to agree with your creditors? Put the number of years there and you are done with that. Now the system only allows you to take note of 3 debt facilities, because if you're going to collect 100 debt facilities, you should ask yourself, are you actually making money? If that's the question and the question is no, please, you need to go back to the TONY ELUMELU Foundation mentor and discuss with your mentor. If ideally they expect that within the next 2 to 3 to 4 years, you should be viable, and therefore any loan you need to collect, you can collect it within these 3 facilities. Now, schedule, after that, you are 90% done. In fact, we are 100% done. Every other thing is just, it shows the outcome of all what you've done in the past. So it shows your schedule of your debt facilities, loan in year 6, year 1 to 5. I didn't collect this loan. It shows me when I collected the loan, how much I collected, how much I have to pay, the interest rate, and my balance. It does that for me. It shows every other thing, your depreciation schedule. It shows it for you. It does the calculation and just shows it to you, and you are done. Gentlemen, ladies, entrepreneurs, that is all you have to do to complete. Once you're done with everything I've mentioned, you are done with the financial model and you can move forward. Now, I think I will probably take questions. I see a lot of questions, and and I think we should just ask questions. Hold on. Are you there? I'm trying to reach to deactivate.
Yeah, Shego, can you hear me?
Yes, I can hear you. Yes. We are
Okay,
practically
so
done
I'm
with the
going
session,
to.
and I want to. Okay.
Yeah, I know. I'm going to enable the chat and questions so people can now ask questions.
Okay. So if you have a question, please can you just type in your questions? You know, any questions you have, please just type it there, and I'll try and answer it. I have some questions that have been marked, but I want you to
So
drop
the
your questions
questions
so that I
can
do
be
not miss
coming
them.
very fast, so you have to be careful.
Yes, I'm going to mark as questions, so it's easy for me to see
Yeah,
the
great,
question and answer.
great, great, great.
Someone asked a question just now. Um, He said in section A, what do I mean by installations in section A? So I'll go back to the assumption sheets and I'll look at section A. In section A, what do I mean installation? Well, installation is, for example, and I'm going to say you buy machineries, you are setting up a factory, you buy your machineries, you might need the suppliers or you might need different people to come and install it for you. That cost is your installation. Installation cost is the cost of setting up your production infrastructure, which is not it's labor tied. So it is the cost of is the cost for labor of setting up your production facilities. Fantastic. Someone says, I see another question there, and I'm going to quickly look. See. Someone says, I do not want to do equity. I will just show that quickly. I do not want to do equity, but my mentor says that my own money is equity. I do not agree. I want to leave it as zero. Well, your money is actually equity. Your mentor is correct, but your money, if you look down the initial startup fundings, your money falls under in section 8. Your money falls under personal savings and owner's capital. So how much of your money are you putting into the business? That is your startup financing. For the purpose of this sheet, equity just helps us calculate how much will be involved in starting up the business. As regards valuation of your company, it's a totally different thing, and I would beg us not to get into that. So for example, I could put in 1 naira, and then in 1 year's time I say my value, I could put in 100 naira, and in 1 year's time I say my company is worth $1 million. If I am the sole owner of my company, it means that my equity is valued at $1 million. Anybody else, even though I put in 100 naira, if somebody brings in $500,000, right? I can decide to say you're bringing in $500 because my company is worth $1 million. Sorry, I'm bringing in $500,000 because my company is worth $1 million. The value of your $500,000 is only 50% of my company. That is the value of their equity when they give me when they give me their money. Although even though I put in only 100 naira, but the value of my 100 naira, as far as the investor is concerned, is worth $1 million. It's a totally different ballgame altogether. Your mentor is correct. You need to take note of the amount you put in your startup financing. Please do not leave it as zero. Thank you. Okay. Other questions. In section D. Other questions? Oh, hold on. In section D, someone asked a question. In section D, if I pay my CEO 700, if I pay my CEO 700, um, 70,000 a month, do I multiply it by 12 before in the baseline? Yes, please multiply it by 12 because the baseline takes in your annual salary, not the monthly salary. So you have to multiply your CEO's salary by 12 and you get your annual salary. I think that is clear. Other questions? Other questions? Sorry, keep sending your questions. I can do this for the next 30 minutes. So take your time, send in your questions and I'll answer them one by one. Hold on, I've seen a question that looks interesting. Someone asks, in section C on startup costs, the total does not capture the initial working capital and contingency. Is that right? Yes, you are correct. It doesn't capture it for you, but in your income, in your balance, in your income statement sheet, in your balance sheet, in your cash flow sheet, it is captured. So your auditors are taking note. Don't worry about it. All you have to do is fill in the assumptions. The auditors or whoever prepared this financial template has taken note of this and the information has been noted. One of the things that has been done is that it has calculated it for you. When you start your business, don't worry. Yes, please.
Yeah, so you just go on for
Yes,
15 minutes and so we can round up and I can upload this video so that the wider entrepreneurs can have access to it.
Oh, okay. All right then. Okay. So 15 minutes. Let's see how far we can go. This is done. Let me look for another question. If particular questions, you are free to send it. Specific questions, rather. Okay, I see a question here. It says 10 years. Okay, someone says 10 years. Okay, let me just go and publish it so you see it. Someone said 10 years feels like a long time for projections. Does it have to be up to 10 years? Can it be up to 3 years? 10 years is a long time, but then they're expecting you to think big and they're expecting you to think long term. I mean, you might assume, for example, let me give you an instance. I produce shoes, I produce slippers. In year one, I'm selling, year two, I'm selling, year three, I'm selling. Now, I expect that the people will always wear shoes, wear slippers, because or people will always wear shoes because they don't want to walk barefooted. I expect that by my year four, I will be producing a new type of footwear based on the fashion trends, right? So my expenses will go up, but the amount people will pay for those trendy footwears would also go up. If you think like this, if you actually think like this widely, I'm sure you can do your 10 years projections. However, nobody's going to fail you for your projections if they are not. For instance, and this is why in your final in the business document plan that in the Word document, they are not asking you to publish. They're not asking you to show 10 years. They're asking you to show 3 years because that information determines whether your business survives or it dies. If 3 years you're expecting loss back to back, people will not invest in your business. And your start, people not invest in your business, and there's so much capital you would have. There's so much customers who would, if people are not buying your product for 3 years, there's no point. So yes, in your Word document, you allow, 3 years projection is fine. The Excel sheet is just to develop your mind as an entrepreneur. So if they ask you for 10 years, just try and think for 10 years. And you'll be, and I guess that is fine. I hope that answers your question. Other questions? Someone asked a question here, and he says, for my equity financing in section I, there is no figures there, solely because I do not intend to get equity financing initially. Please, can you explain more on equity financing? Equity financing is the amount of money you expect to get from external sources to sustain your business. Some people source equity funding because they are low on cash. Some people source equity funding because they want some of their investors to recoup their investments. So, for example, you got equity funding in year one. In year six, people invest some people invested in year one. The business is not so profitable, but there is value. The value of the valuation of the business has grown up. Some people go to get equity funding so that they could give people that invested in year one some revenue or some value for what they invested. So the equity that is they pay off their equity funders from year one, and then the remaining money is put back into the business to improve production and improve marketing so that there is improved sales. So yes, you are fine. It's up to you. If it's not from the word go, if you don't expect to get equity, you can leave it. Somebody asked a question now. Somebody said, is there a provision to add capex, e.g., purchase of equipment after year one? No. On this template, the answer is no. But please, you can put it there. I encourage you to put that in year one. Now, what you would do, this is what I did in my own case. So, there are some of the expenses. For example, I did not expect to buy cars in year one, but I put in, I made accommodation for vehicles in year one. What I did is in my business plan, in the Word document, I stated it clearly that some of these expenses are not critical and they are important. I'm going to make them in year two and year three. But for the purpose of my projections, I put in the amount. It's clear to Accenture as they read your business plan that yes, that amount is there, bulk figure is there in year one, but you're not spending so much in year one. I hope that answers your question. Please, when it's 15 minutes, just let me know because I really go on and on doing this. Somebody asked a question. Someone said, the financial summary chart shows that I'm making profit, but my company's direct cost seems to be too low. I run a digital agricultural platform. Is this okay? Now, I will tell you this without fear. What has happened is because most of your expenses are in year one, and I'm assuming that you did your assumptions properly. Now, most of your expenses are in year one. Because you're not going to make these expenses in year two, year three, year four, year five, all you have to do is just have maybe running cost of the infrastructure you put in place in year one. What happens is that from year two, year three to year 10, the cost of production reduces, your expenses reduce, but your profit increases because more people are using your platform, and that is why it is like that. The only case where it will not be like that is if, for example, you have overestimated your revenue. If, for example, you are saying, I'll make 1 million sales in year one, obviously, your revenue will look very, very high and your expenses will not show. Aside that, if all your projections are on point, well, it's expected to be like with IT service business, and that's why they ask you, is your business scalable? So if they are scalable, it means that the cost of duplicating your service in new market should not be so high, but your revenue should increase. I hope I have answered your questions. Thank you very much. Other questions? Somebody asked a question. It says, I have a single product with different price categories. How do I reflect this on my revenue section? Now you have a
So it appears Shegu might be having some network issues. What we're going to do right now is we will probably end the session. Thank you to Shegun. And I will upload this on YouTube so that everybody will have access to it. And as I can see some of the questions here, he has answered quite a number of them. There's this question that has come up several times. I see a lot of you are behaving like kids, pardon my language, and uploading wrong documents. Just imagine, I want you to use your head and imagine that everybody uploads the wrong document and we have to go back to remove the wrong document. Imagine the amount of work. So sometimes when you make complaints, think about the amount of work that happens on our end, having to respond to everybody, having to make sure the program goes on in time, having to arrange your seed capital, and then having to start deleting documents that people uploaded wrongly. After today, I will not respond to anybody that uploads the wrong document. Today, we'll find a way to go back and delete those documents. But you have to send an email because we cannot delete everybody. After today, this request will not be honored anymore. All right. What else? What else? What else? All right. So we have to give it. Oh, please explain what cycle we're uploading. Everybody's on cycle one. The cycle are the amount of times that we have to review the business plan. And even if you see 4 or 5 cycles there, only 3 cycles are open to you, which means if your business plan is not approved, you're allowed to rework it only twice. After that, sorry, no seed capital. All right, thank you so much. Thank you, Shegun. You guys have to thank Shegun. Shegun is an entrepreneur like you, and Shegun has put in so much into delivering this webinar. Remember the deadlines. Look at your emails because we'll be sending you a couple of emails from time to time. And the link to this webinar will also be made available in 30 minutes. You guys have a great day and remember your deadlines. And lastly, we've noticed that quite a number of people have not updated their tasks up to about 50%. Please, please, please look out for your fellow friends and your fellow entrepreneurs and help them. Remember the deadline for the task was 25 July, which means that we are in our rights to remove them from the program. But I don't want to be the wicked person. I don't want to be the person that stops you from achieving your dreams. So please, please, please ensure that everyone that you know complete their task. Thank you. Have a lovely day.